Hi, my name is Christian Waldegrave, Head of Research at Teekay Tankers, and this is our conventional tanker market update for June 2019. Well, in the last video in April, we talked about how after a decent Q1, the tanker market had started to come off in March and April into the start of the second quarter. And that's continued throughout the second quarter. We've seen rates at lower levels, certainly that we saw in Q1 and Q4 of last year. Although I think it's important to say that rates are a lot higher than they were this time last year. And that weakness in rates is being caused by, firstly, normal seasonality. We always see rates coming off from the winter market into the spring. But we've also seen some factors really creating some headwinds for the tanker market at the early part of 2019. And they include OPEC supply cuts. And then within that, US sanctions on Iran and Venezuela, which has reduced exports from those countries. We've seen more extensive refinery maintenance this spring than in previous years, and that's probably as refiners gear up for IMO 2020. And we've also seen relatively high fleet growth at the start of the year as well. So that's really impacted on the rates coming into Q2, and particularly on the larger size tankers. So VLCC rates last month were at a 9-month low. Suezmax rates were fairly low as well, and the Aframaxes were particularly impacted by the US sanctions on Venezuela, which has reduced those Venezuelan cargoes moving on Aframaxes to the US Gulf, and that's weighed down on the Aframax market. At the start of June, though, we have seen some early signs of life that the tanker market may just be on the verge of improving a little bit in the next month or two, and that's due to a few factors. Firstly, refineries are starting to exit from seasonal maintenance now, so that means more demand for crude oil. We're also seeing, just looking at the cargo tracking data, it does seem as though there's a bit of an increase in cargoes coming out of the Middle East at the start of June, which should help lift the VLCCs. And we've also seen this week that the Suezmax market out of West Africa has improved as well. And also just looking ahead to the month as well, we think that Black Sea exports may improve. We're seeing increased flow through the Black Sea now that the Kashagan field in Kazakhstan is coming up to full production volumes. And as the refineries in Asia come out of maintenance, we could start to see some of those Black Sea volumes moving to Asia like we did towards the end of last year, which was a good support for the Suezmax market. On the Aframaxes as well, we have seen a better market in the European side of things, in the UKC and Baltic. And that's been partly driven by more imports into Europe because of contamination issues on the Druzhba pipeline, which comes from Russia into Eastern Europe. So a lot of those refineries are not able to receive Russian oil at the moment, and they're having to import by sea instead. So we're seeing a little bit of volatility on the Aframaxes. And then on the LR2s as well, we have seen the LR2 market start to improve, and that's really because, again, the refineries are starting to come out of maintenance, which means more product cargoes. And we're also starting to see as well possibly the start of some of the IMO 2020 impact in terms of refineries having to step up their production of distillates, and that's benefiting the product market. So we are starting to see some signs of life at the start of June. I think it's too early to say that this is the beginning of a more sustained recovery. I do think the tanker market will continue to face a few headwinds through the rest of Q2 and probably into Q3 as well. Chief of which is the fact that the oil futures curve is still in a fairly steep backwardation. And that means that refineries really are disincentivized to hold inventory and build stockpiles. So that's going to be a little bit of a headwind for the next few weeks. And also with crude oil prices having fallen through the month of May from sort of $70, $75 back to $60 a barrel, it does seem likely now that at its next meeting later this month that OPEC will probably decide to extend production cuts. So that again will be a little bit of a headwind that will continue into Q3. So a little bit of an improved market looking into June, but still some headwinds to negotiate in the coming weeks and months. But once we get beyond that, we still believe that the fundamentals will improve as we go through Q3 and into Q4, and certainly into 2020. And that's really going to be driven by a couple of things. Firstly, we do believe that cargo supply will improve as we go through the year, especially from the United States and other exporters from the Atlantic basin, such as Brazil as well, going long haul to Asia. and that'll be a really big driver of ton-mile demand for crude tankers. And that should especially gather some steam in Q3 and Q4 when we see new pipeline capacity from the shale regions of the United States coming down to the US Gulf Coast, which will allow more US crude oil exports. So that should be a positive factor. We do also think that refinery throughput will increase substantially in the coming months. The IEA says that refinery throughput should improve by over 4 million barrels a day from spring through to sort of August, September time. And on top of that as well, we should start to see the positive impact of IMO 2020 in the coming months, with refineries having to take in more crude to produce sufficient distillates. And also I think those regulations will create some new trade patterns and some arbitrage trading as well, which will help tanker demand. And then finally, after having quite high fleet growth at the start of the year, that fleet growth is set to drop off significantly as we go into the second half of the year and certainly into 2020. If you look at the tanker order book now, when you look at the order book as a percentage of the existing fleet, it's now less than 9% of the existing fleet size, which is the lowest it's been in 22 years. And so that's really going to set the tanker market up for a more sustained recovery starting later this year and then going through 2020 and into 2021. Probably the one wildcard that could create some softness in the market going forward is what's happening in the macro economy, and especially the trade wars between the US and China, the uncertainty surrounding Brexit, and things of that nature. And we are starting to see just some weaker signals coming from the global economy, which could then filter down into softer oil demand through this year and next year. At the moment, it's a bit of a wait and see. We're not factoring that into our sort of base case forecast, but certainly it's a downside risk as we move through the rest of this year and into 2020. But for now, I think we are starting to see the market just beginning to turn around a bit. And then as we go through Q3 a bit more into Q4 and into 2020, we certainly think we're going to be in a much stronger tanker market than we are today. So that's our update on the conventional tanker market, and we'll speak to you again soon.